Hello and welcome to the Monday Futures Market Outlook for June 25th, 2012. This is Patrick Sresna. For those of you that have not had the opportunity to try out the eminisource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the US dollar index futures and try to identify the key trends in the currency markets. And subsequently, we have now, we're looking for a short-term bottom on the US dollar in what we anticipated was simply just a natural consolidation that we felt would be all contained to the $81 level on the downside. Subsequently, we're now seeing last Thursday a very bullish reversal signal coming up to break that line, and we're looking to see whether or not this has the follow through. And if it does, then we anticipate that this move is likely to push all the way up to the 84-85 level on the upside in this next push. And there are even some suggested measured moves that could even target levels as high as 86 or even 87 on the upside during one of those moves. We remain relatively bullish the US dollar as a part of our primary theme from our intermarket perspective. A part of that US dollar bullish theme comes from the fact that we continue to see predominant weakness in the euro. And when we take a look here at that euro FX currency chart, we can see that we had that same sort of kind of like a wedging flag that has now given some sell signals on the breakdown. We were looking for the highs of the euro to come in somewhere around the 126, 127 level, and suggested that a full retracement could even have seen 128 to 130 on the upside, but not that it didn't mean necessarily that the euro had to go that high. Again, we're seeing some follow through selling this morning, which is indicating that we're going to test a crucial zone that's going to determine whether or not the breakdown occurs, which is right around this 124 level. If we have any substantial breakdown of the 124 on the downside, it would open the window for not only a double bottom retest at 123, but allow the room for a move that measures all the way down to even 118 to 120 on the downside. So we're going to watch to see whether or not this kind of follow through occurs. It would be a US dollar bull environment that would allow the euro to weaken. So the two will go hand in hand if we get this breakdown. Next year, when we take a look at the 30-year Treasury bonds, we continue to have a relatively bullish bias on them, even though we've not got a new buy signal off of this consolidation. We were looking for some sort of flag or wedge to take a breather off of what was a really huge 2-month push higher on those bond markets. But we do believe that so long as we are in a bullish U.S. dollar environment and the markets continue to be struggling, that money will continue to flow into these Treasury bonds, allowing them still yet to move substantially higher. We think at some point when this gives another bull signal here, we could not only have a retest of the previous highs, but there is certainly room for us to see even levels up to 156 or 158 on the upside during another substantial push higher. When we take a look at copper prices, copper continues to be predominantly weak. Very poor rallies on the upside have always been met with new waves of selling as there are concerns for global recessions. Dr. Copper is basically continues to be under pressure with us now testing at major support line at this 325 level. Any substantial follow through selling below there will take out the lows from November and December and immediately open a window for a test of the $3 to 305 level. But really in the end, we do actually have targets that could even go lower down to even the 285 to 290 level if the selling really accelerated on the downside. Nonetheless, at this stage, the best case scenario here is that the bulls will be able to muster up a little double bottom, but so long as those currencies remain in trend, it is likely that copper has further weakness yet ahead of it. Next year, we're going to take a look at crude oil, which has been extremely oversold on the downside, and by no means am I suggesting that the crude oil selling is over. We are at a critical support line at the 75-77 level on the downside. This is a place where we can naturally see a bounce. That's where the lows came in October on crude oil, and so some short-term support that could happen. If we see that very strong currency moves, there definitely is room for crude oil to do a slight overshoot, but we probably are looking for that. If it does overshoot, the periods below $75 would probably be short-lived in terms of maybe at most a week or so trading below there, which could see lows even in the 70 or 68 level on the downside. That would have to be driven by an inner market push, because if there's US dollars having a substantial rally, it would be hard for the crude oil bulls to bang out a short-term bottom without there being another input variable. So at this stage, while we're just recognizing a very oversold crude oil market, but one that is naturally still weakening. Next here, I want to take a look at gold, and when we take a look at the gold futures, we were talking about that being a big rising wedge formation on the upside, and suggested that the 1650 area should contain all the upside rallies. Really, at this stage, with last week's very strong reversal on the downside, it's likely that gold is going to go through another weakening cycle here, which could see gold futures trade even as low as the 1440 level on the downside during a substantial debasement. Silver has already broken a key level, and so these precious metals are still in the process of selling, and then subsequently will need to bang out a bottom before we become much more interested in owning these. That brings us to wanting to look at the S&P 500. As always, we start off with a weekly chart going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that the market has gone through. We remained above that 80-week moving average, but it lies right around the 1290 to 1300 zone, which is a level that could even be tested today on the downside. Ultimately, if there is any substantial weakness on a week-in, week-out basis below that 1290 level, it would be the first time since last year where we saw some negative price action indicating a much bigger picture correction. Interestingly enough, the S&P 500 is pretty much the only major global indice that is actually holding above these levels. If you go to any other global indices, they're already distinctly trending down in bear market territory. So question is, will the U.S. market naturally get pushed down below this by the weight of the global markets? So we'll find out obviously in the upcoming month. That brings us to taking a look at the S&P 500 on a daily chart, and we were looking at this rising wedge on the upside, suggesting that it should find substantial overhead resistance in the 1340 to 1360 area, and that there is a chance that a key top retest could even go as high as 1380 on the upside. But again, Thursday, when the short call on the market came in, the market has substantial reversal and continues to weaken, giving no indication that the bulls are prepared to start buying this market. So long as this trend remains the same, there is risk that the S&P 500 will have already begun a new round of weakness. That 1300 level and then subsequently the 1290 level are those sort of key line in the sand zones. And we could always see like a double bottom retest or a slight overshoot down to, let's say, 1240 on the downside, and a very quick kind of sell-off that really kind of capitulates the selling on the downside, and before we bang out another short-term bottom. So we're watching to see what kind of follow through here is there, but because we're of the level where we reversed from, our bias still distinctly remains another leg lower into July is likely in the market. Just to make some key intermarket observations, we remain both on the short-term and long-term U.S. dollar bullish here. At the same regards, inversely, we're bearish the commodity markets as we continue to see deterioration in all commodities based upon these things. On the short-term, on the bonds, we remain neutral because we haven't seen that bull signal come in, but we were very quick to want to turn to a U.S. bullish on U.S. bonds if there is any reversals back on the upside. In the same regard, we continue to be short-term bearish stocks, but in order for us to change our long-term stance on stocks to being bearish, we would need to see substantially more bear market style price action in the U.S., which is simply not there. So while we certainly do believe there's room for the stock market to remain weak here on the short term, it doesn't necessarily mean we're long-term bearish stocks here. But in the same light, we want to emphasize that the global stock markets, basically almost every market outside of the U.S. is distinctly in a big picture bear market, whether it's global economic slowness that's driving it, or whether just broader distribution and weighing more weighting into resource-based names and things like that. But nonetheless, there are some very big bearish signals on global stocks, and that begs the question as to whether the U.S. stock market can still live in its own little bubble outside of that of what's happening in the rest of the world. That was your Monday Futures Market Outlook. Thank you for joining me.